Welcome to the Master's Certificate in Technical Analysis. This is the video for Module 15. In this module we'll be talking about options and various ways of trading options. Options, as you may guess from the title, they give you choices. This is very different from most other things that you're trading. Futures, the last module, you have a contract at some date in the future and you have to go through with that contract. You have the price agreed, you have the date agreed, and the quantity of whatever it is that you're buying, stocks or whether it's a commodity, and you have to go through with it. You've agreed to buy or sell something, and you may lose or you may gain, depends on how commodity's price varies on the expiration date. With options it's different. You have to buy yourself an option, because you're getting yourself a choice. If the underlying does not go up in value in the option, never mind, you don't have to buy it. If it goes down in the value, never mind, but if it goes up in value, you've bought yourself the chance to buy it when you're buying an option. So you're really just paying an insurance to cover your downside. The downside of an option is known as the start, or paid at the start. It's the cost of the option. That's all the downside you have on a single option, and the upside is dependent upon what the options are. So as we've just said, options will cost you. It's not like the futures, where the futures contract is set up, the buyer and seller choose the contract and it's mutual. They don't pay anything, or they don't pay more than they feel they should. Obviously the price of the underlying may vary, and in the futures contract it's set up in the value. But it's a neutral between the buyer and seller. They both agree the contract, otherwise they wouldn't have gotten into the contract. One of them, if they felt they were taken advantage of, they wouldn't have run the contract. But with options you have to pay for that, but that removes the downside. There are two types of options. The first one we'll talk about is called calls, and that's when you can call for the shares or call for whatever it is at the underlying of the option at the expiration date or sometimes before. So you may have a call option on 100 IBM shares in May at $100 a share, and you've paid for that option. IBM makes the trading below or above, who knows. If they're selling above your call for the shares, say at 120 a share, you can get that at 100, but if it's not trading at 100, you can walk away. The option just expires. It's worthless, and you've paid a price. You've paid an option, but you don't lose anything because of the shares going down. The opposite of that is a put. Now a put means that you can put a share with somebody, and if you buy a put, you buy the right to sell your shares to somebody at a certain price to somebody else. He may not have the shares right now, but the option gives you the right to sell the shares at a certain price. So this typically would work if it's a bear market. You would buy the option of put to sell the shares dropping at the price from 100 to 80. But you've got the option that says, hey, I can put them with you, and you've got to pay me $90 or whatever that is, or whatever price is agreed. So a put is opposite to the call, but the shares go away. Put the shares go away, call the shares come to you. Now another bit of jargon, that's the strike price. Now unlike futures that have prices for certain expiration dates, with options you have a range of prices. It's laid down by the exchanges depending on what the price is. It may be in $5 increments or $2 increments or whatever it is, whatever the dollar increments are, but you have a strike price of $50, $55, $60, $65, and you'll see a list of tables, and you'll look at the options. I think we have a table in the module actually, but obviously if it's far too away from the current trading price, there's no interest in it. You could probably have bought it, but if it's around about the current trading price, then you have a choice of what value you want. An expiration date or delivery date is the third Friday of the month that's mentioned in the pricing table. It's always on the third Friday, but you can choose your month, so that's the other item for the option. Now you can have options on all sorts of things, as you may imagine. An equity option. Equity is a share, so you can have a share option or a share option. An option for an equity is for 100 shares. You don't have to buy 100 options, as options an option automatically is for 100 shares. So you can buy one option, and that'll give you a call with a right to buy 100 shares at that price on the expiration date. Next type of option is the index, but the index is the same price as the future. It may be a bundle of 5,000 shares, or it may be 30 shares, but it's not practical to deliver those shares, so these are always cash settled. Usually the equity options are physically settled. You normally get shares if you take it through, and then any time you don't want to take the option through, it's selling above or below the market, and you don't have to go to the close. But you normally get the shares if you do the equity shares, and you wouldn't get the shares if you wouldn't just do the index option. The index just gives you the exposure to the market as a whole, and you can trade appropriately. Next is the commodity option. It's very confusing. It's not actually an option to buy a commodity like £40,000 of bacon, but the commodity you trade is a futures contract. It's actually an option to buy or sell a futures contract, so it means you're not committed. So if you're a farmer, say, you're not sure how good your harvest is going to be, so you might say, I'm pretty sure I'm going to get 40 tons here, so I'll do a futures contract for that. But the idea is it depends on the weather, whether you're going to get 20 tons you did last year, so I'll do an option for that. And if it works out, that's good. I'll sell 20 tons of corn, or whatever it is, for the price you've agreed on. So commodity option is a little different because you're just trading a futures contract. The next one is currency, foreign exchange. You get them right. They're the obligation to exchange two currencies at a separated and set time in the future. So unlike a future, you're not locked into it. But if it's gone in your favour over the time of your expiration date, then you'll take up the option and you'll take it up, and that's one that businesses will use. Next one is interest rate. If it's an option on interest rates and the interest rate goes against you, then the option compensates you, and if the interest rate goes in your favour, then you don't care. The option expires and you're still going with the interest rate. The option makes a payment for whatever change the interest rate's going to get, and that's cash settled. And finally, binary options. I don't think of them truly as a sort of trading vehicle. They are a gambling vehicle. Really, it's a yes or no. Binary is 0 or 1. A binary option is purely a play on whether the index will go up or down in the next hour. It's a very short term, and it may pay you $100 if you want to bet that it's going up, or it may cost you $60 if you want to bet that it's going down, or it may cost you $50, and there's the margin. Dealer's going to get a bit more, 100 is going to pay out, and he takes a few on how likely the stock goes down and sets the rate that you have to pay to take on that bet. If the bet goes in your favour, you get the profit. But I don't think of it as such a technical option, but this is a simple one, and it's something that some people like to do. So let's look at some option strategies. First one, American versus English. This hasn't anything to do where the option originates, really. There's just two styles of options. The English option can only be exercised, can only be cashed in on the expiration date. That's it. Your shares go up, way up, but if you come down by expiration date, you don't gain from it. The American option has the theoretical choice that if you can cash in at any time. If the shares have gone up $10 and you think it may come back down again, sure, cash it in, but that's not always the best way to behave. The American option does give the option of whether you want to buy, and you usually pay a little bit more for the option because of that. But as I explained in the text, you usually won't use the option to cash in your choice. You'll always have the choice. Doesn't mean you sit there and you wait for the final day and say, oh, oops, I've lost the profit we had. Obviously don't sit on your hands and wait, but say your option is in the money, say your underlying has gone up, say your option is in the money, you might want to cash in those shares and make a profit. What you're going to think is that the option that you have is going to be worth more than the profit. That's simply because the option is always worth the underlying intrinsic value, plus it's always a little bit more for the time factor. You go higher and the option will always cost a little bit more for that. So you'll get more profit just by selling it on the market. There are a few other things you could do. If you're planning to exercise the option and keep the shares and you exercise it clearly, you could just spend your money you were going to get on buying those shares and you'll get interest on them. So if when the expiry date comes the cash price is still in the money, then you can cash in on the investment and buy the stocks. So it's just simple. You buy the stocks and you've gained the interest because you've always going to buy the stocks at that price. You've got that option, but if the stocks are going down, then you can cash in on the investment and you buy the stock straight on the market and you profit from the difference there as well as from the interest. So basically what it boils down to is that the only time you really need to consider about exercising an American option early is if you think there's going to be an advantage from getting a dividend, and that's really the only time that you can score more than going through the various cases in the text of the things that you can do if you want to keep the stock options the American way. But unless you're going to get the dividend and the dividend is worth more than the interest, you're going to get. Don't bother exercising the American early, but do look at how they're performing and take appropriate actions. That's not really a strategy or more as a thing you must do. A simpler strategy is called the covered call. A covered call means you're going to make money by selling an option. Now this is the other side of options. You don't always have to buy them and spend money. You can sell them too. But if you sell them, you have an obligation to fulfill that option. If it's in the money for paying the premium on that price, you have an obligation. You don't have a choice, and once you start selling options, you're set. You're fixed into having to fill that option if it means money for the other person. But a cover call, you have to sell the call, you have shares to cover. So say you had 200 IBM shares, you could sell 2 call options on IBM. It's 100 shares per option. Don't have to sell at all that much, but you can do, and you've covered if the shares are caught away from you because they're in the money. So you're not going to be out of pocket. As such, you've got the shares already and you're going to get the money. Some people just trade on this alone. They basically take the shortest expiration date they can have, set the call up on probably around the current price because they've got a good premium for it, and take the money, and you'll get a good 2% a month for it. Doesn't sound like a lot, 24% a year. Of course, the danger as such with the covered calls is on all the stocks you're carrying on during that is if the call finishes during the money and you have to let the shares go at a price the call is at, and then you have to go back and set it up again by buying some more shares. So that's the only thing that'll stop you from keeping on getting it at 2% or whatever it works out to the option prices month after month. So it's a very handy little tool to make profit out of shares that are just sitting. Another simple idea is a naked put. Naked means you don't have the shares, you don't have any position on the shares, short or long, and you sell a put. Again, by selling a put, you're taking on a responsibility, an obligation, but you're getting money for it. But its use is to say, if you want to get some shares and you say, hey, I don't like the price they're trading at, but if they drop to $5 I might get them. Well, we'll sell a put for the price you're prepared to pay. The worst thing that can happen is that you get the premium and the shares don't drop. Fine, you don't get any shares, but you have got the premium for selling the put, and if the shares have dropped in price to the price you want to pay, you say, great, thank you, I want to buy those. So you get the shares at the price you want, and you still got the premium. You always have, and again, this is something that till you buy the shares you can keep it month after month. So you can keep it till the shares don't drop, but if they don't drop, well, you're going to get all the premium anyway. So again, you might go into the market and say, Mr. Broker, please tell me, will they drop down to my price level? I'm going to buy them. Why don't you just sell a put for the price level and let the market get your shares, get you the shares, and it will, and you'll get a premium above that, so you know it's a choice. Another strategy is a host of strategies really, but spreads. We spoke about that in futures. So basically there are two contracts for some things related, for the same things related. In options, quite often a vertical spread is called that because of the way the price table is laid out. The options expire the same date, same month. They both have different strike prices, and so you might buy a $50 call and sell a $55 call. That's a bull call. You think the shares are going up. $50 call is more expensive because it's closer to the price than that's expected to be fulfilled. So it'll cost you to do that. It'll cost you a fraction of that $5 difference, but if the shares do go up, you'll have to exercise your call at $50 and sell at $55. So you'll make $5 a share less whatever the option cost for you. So if they go well over the top, then you'll make a set amount, and only a set amount, because you've covered yourself against the losses. Say the loss that you have is $2. Say if it costs you $2 to buy the option, then again you're limited as well. So it's a very risk-free move in trading, and if you look at the prices in the options, you'll find some of them will work for you. All you need to look for is whether it's going to be a bullish market. As in all sorts of trading, you have some sort of view of the market. You need to know whether it's a bullish or bearish. Next is protective put. That's bullish as well. You buy stock and then you profit from the increase in the price, so you buy a put option, and that means that you've spent money, so the stock has to rise in value at least as much as it cost you, but then your profit is not limited after it rises above that. If the stock falls, then you'll exercise your option and you can sell your shares anyway. So you can protect your gains. If your stock has risen in value and you buy a protective put at that price, and you protect those gains if the stock goes back down, you're covered, and the price of the option is basically insurance against the stock backing down. There's another way to play that. It's called a stock swap. You'll actually get rid of the stocks, but you'll buy a call option for the same number of shares for the same price. So if the price does go down, then you don't have to exercise the call option, so you don't lose your profit. If the price keeps going up, and then you'll exercise the option and you'll make profit, and your profit is reduced by the cost of the option, but it's protected you from any downside. So again, that's a good way of using options as some sort of insurance or hedge. Another one you can do is called a long put. That's a bearish option. You think the stock's going down and you don't short the stock, and there's some disadvantage to shorting your stock. It can get called away by a broker if the share is borrowed, so it's called back. And also if you short the stock and it goes up in value, well, that's a loss to you. If you get a long put, it's going to cost you, and you don't lose if the stock goes up. You're protected against it, but your stock has to go down by the amount of the premium so you can start gaining. But it's another way of playing a short position and not exposing yourself to the loss of the price going up. There are a couple of other things you can do. Straddle. This is where we get to the point where you can make up your mind. You say this is a very volatile stock, and you don't know whether it's going up or down, but it's getting squeezed down there. Bollinger Bands are squeezing in, or it's squeezed into some sort of triangular formation. It's going to break out, but I don't know which way. So straddle doesn't care which direction the move is. Straddle is a combination of a call option and a put option in the same stop, and the same price with the same date. If you think it's going to go a long way away from its current values, you would buy the call option and the put option, but that's a long straddle. Your total risk is what you've paid for them. Now if the stock goes up, use the call option. If the stock goes down, put option is there. One of them always expires, and the other one makes you the money. As long as it moves far, you can make money. So that's the long straddle. You can also do a short straddle, and that is sell both and sell both the call and the put for the same price for the same date, and all you get out of that is the premium for selling a call or put. So you're going to limit it on the upside as long as the stock doesn't move too far from the price, then you've made a profit. And you have an unlimited downside if it moves a lot, so that's a short straddle. And then you have a strangle, which is related, but it's different than a straddle. So you can choose options that cost less, but depending on which way you do it, either if you're doing the long way, your stock has to move further before you can make any profit, or you can do it the other way. You'll get less premium for selling a call and a put, but you've got a little bit more breathing space for the stock to move before you start actually losing money. So that's just some basic ways you can play with options. You can do all sorts of things with options. You can do things that require you to buy stocks or sell, put or call. Doing more than two things. All these really are just two things at a time, and people have thought of all sorts of elaborate strategies that you can read about them in books dedicated to options. But this gives you the basic grounding. This gives you a lot of strategies, and you'll find these strategies take care of 95% of the situations when you want to use options. And now you know how to use them, and how to use them effectively to limit your risk, if you want to do that. And basically that gives you a playbook of what you can do with options. So options are the right but not the obligation to do a trade in the future, and lots of people like them because you can, as a basis, can limit your downside to just what you've paid for the option. It obviously depends on what you can do in the strategies by fixing yourself up, but on a basic trading basis, and a simple option, your downside will be limited, but your upside won't be so limited. And so it is with futures. You're going up and down, you're always exposed to more risk, and there's more action, and you have to start with what is your risk price profile. Obviously during the course we've emphasized that you'll limit your losses, and you make sure that you get out of a trade if it's going down, and you make sure you don't oversize your position, and that applies to any of these strategies in any case. So bear that in mind. Just make sure your position size so you don't lose the house in one trade and wipes you away. That concludes the options module. Next, module 16, we're going to talk about Forex, foreign exchange, and how you can apply technical analysis to that. That again is particular techniques. Some things work better than others in Forex. So I look forward to talking to you in the next module, and it's goodbye for now.